Welcome to our deep dive into profitability analysis, a crucial tool for any business aiming to thrive. In this video, we'll explore what profitability means, why it's important, and how you can use it to make smarter decisions. Whether you're a small business owner or a corporate manager, understanding profitability is the foundation for sustainable growth. We'll start by defining key concepts and then move into practical examples, ensuring you have a clear grasp of how to analyze and improve your business's financial health. Let's begin our journey by exploring the basics of profitability and setting the stage for more advanced insights. Profitability refers to a business's ability to generate earnings compared to its expenses and other costs. It's not just about making money, but about making enough money to cover all costs and still have something left over. This concept is central to every business, regardless of size or industry. By understanding profitability, you can assess whether your business model is sustainable and identify areas for improvement. In the next scenes, we'll break down the different types of profitability and how they impact your overall financial performance. There are several types of profitability that businesses track: gross profit, operating profit, and net profit. Gross profit measures revenue minus the cost of goods sold, operating profit subtracts operating expenses, and net profit is what remains after all expenses, including taxes and interest. Each type provides unique insights into different aspects of your business's financial health. Understanding these distinctions helps you pinpoint where your business is excelling and where it may need attention. Next, we'll look at how to calculate these profits and what they reveal about your operations. Gross profit is the starting point for profitability analysis. It's calculated by subtracting the cost of goods sold from total revenue. This figure shows how efficiently your business produces and sells its products. A high gross profit means you're keeping production costs low relative to sales, which is a positive sign. However, it doesn't account for other expenses like marketing or administration. In the next scene, we'll move on to operating profit and see how additional costs impact your bottom line. Operating profit takes gross profit a step further by subtracting operating expenses such as salaries, rent, and utilities. This metric gives you a clearer picture of your business's core profitability, excluding non-operational costs. If your operating profit is strong, it means your business operations are efficient and profitable. Weak operating profit signals that expenses may be too high or revenue too low. Next, we'll examine net profit, which includes all remaining costs and gives the most comprehensive view of profitability. Net profit is the ultimate measure of profitability. It's what remains after all expenses, including taxes, interest, and one-time charges, are deducted from revenue. Net profit shows the true earnings of your business and is often used to assess overall financial health. A positive net profit means your business is not only covering costs, but also generating value for owners and shareholders. In the following scenes, we'll explore how to analyze profitability ratios and what they reveal about your business's performance. Profitability ratios are essential tools for comparing your business's performance over time or against competitors. Common ratios include gross margin, operating margin, and net margin. These ratios express profits as a percentage of revenue, making it easier to spot trends and benchmark results. By regularly tracking profitability ratios, you can identify strengths and weaknesses in your business model. Next, we'll look at how to calculate these ratios and interpret their meaning. Gross margin is calculated by dividing gross profit by total revenue. This ratio shows how much of each dollar earned is retained after covering production costs. A higher gross margin indicates efficient production and pricing strategies. If your gross margin is low, it may be time to review your cost structure or pricing. In the next scene, we'll explore operating margin and how it reflects the efficiency of your business operation. Operating margin is calculated by dividing operating profit by revenue. This ratio highlights how well your business manages operating expenses relative to sales. A strong operating margin means your core operations are profitable, while a weak margin suggests inefficiencies. Regularly monitoring operating margin helps you identify areas for improvement and maintain healthy business operations. Next, we'll discuss net margin and its significance for overall profitability. Net margin is the ratio of net profit to revenue. It's the most comprehensive profitability ratio, reflecting all costs and income streams. A high net margin means your business is not only efficient but also resilient to challenges. Tracking net margin over time helps you spot trends and make informed decisions. In the next scenes, we'll look at factors that influence profitability and how to improve your margin. Revenue growth is a key driver of profitability. Increasing sales can boost profits, but only if costs are managed effectively. Sometimes rapid growth leads to higher expenses, which can erode profitability. It's important to balance growth with cost control to ensure sustainable success. In the next scene, we'll explore how cost management strategies can enhance profitability. Effective cost management is essential for maximizing profitability. This involves identifying unnecessary expenses, negotiating better deals with suppliers, and streamlining operations. By regularly reviewing your cost structure, you can find opportunities to save money and improve margins. Next, we'll discuss pricing strategies and their role in profitability. Pricing is a powerful lever for profitability. Setting the right price can increase revenue and improve margins, but it requires careful analysis of market conditions, competitor pricing, and customer value perception. Experimenting with pricing models and monitoring their impact helps you find the optimal balance. In the next scene, we'll look at how operational efficiency contributes to profitability. Operational efficiency means doing more with less. Streamlining processes, automating tasks, and reducing waste can significantly boost profitability. Efficient operations lower costs and improve service quality, leading to higher customer satisfaction and repeat business. Next, we'll examine how innovation and technology can drive profitability. Adopting new technologies and innovative practices can transform profitability. Automation, data analytics, and digital tools help businesses operate more efficiently and make smarter decisions. Investing in innovation often leads to cost savings, improved products, and new revenue streams. In the next scene, we'll discuss the importance of monitoring profitability over time. Regularly monitoring profitability is vital for long-term success. This involves tracking key metrics, analyzing trends, and adjusting strategies as needed. By staying proactive, you can quickly identify issues and capitalize on opportunities. In the next scene, we'll look at how benchmarking against competitors can provide valuable insights. Benchmarking involves comparing your profitability metrics with those of similar businesses. This helps you understand where you stand in the market and identify areas for improvement. By learning from competitors, you can adopt best practices and avoid common pitfalls. Next, we'll explore the role of financial statements in profitability analysis. Financial statements such as income statements and balance sheets are essential for profitability analysis. They provide detailed information about revenue, expenses, assets, and liabilities. By reviewing these documents, you can gain a comprehensive understanding of your business's financial health. In the next scene, we'll discuss how to use profitability analysis for decision-making. Profitability analysis informs strategic decision-making. Whether you're considering expansion, new product launches, or cost-cutting measures, understanding profitability helps you make choices that support long-term success. By basing decisions on solid financial data, you reduce risk and increase the likelihood of positive outcomes. Next, we'll look at how profitability analysis supports business planning. Business planning relies on accurate profitability analysis. By forecasting revenues and expenses, you can set realistic goals and allocate resources effectively. Profitability analysis helps you anticipate challenges and develop strategies to overcome them. In the next scene, we'll discuss how profitability analysis can attract investors and support funding. Investors look for businesses with strong profitability. Clear, accurate profitability analysis demonstrates your business's potential and builds confidence. By presenting solid financial data, you can attract investment and secure funding for growth. Next, we'll explore how profitability analysis supports sustainable business practices. Profitability analysis encourages sustainable business practices. By identifying waste and inefficiencies, you can implement changes that benefit both your bottom line and the environment. Sustainable practices often lead to cost savings and improved reputation. In the next scene, we'll discuss the challenges of profitability analysis and how to overcome them. Profitability analysis can be challenging due to complex data, changing market conditions, and unpredictable expenses. It's important to use reliable tools and stay updated on industry trends. By addressing these challenges proactively, you can ensure accurate and meaningful analysis. Next, we'll look at common mistakes to avoid in profitability analysis. Common mistakes in profitability analysis include ignoring indirect costs, relying on outdated data, and failing to benchmark. Avoiding these errors ensures your analysis is accurate and actionable. Regularly review your methods and update your data to stay ahead. In the next scene, we'll discuss how to use profitability analysis for continuous improvement. Profitability analysis is not a one-time task. It's a continuous process that helps you adapt to changing conditions and improve performance. By regularly analyzing profitability, you can make incremental changes that add up to significant gains over time. Next, we'll look at how profitability analysis supports long-term growth. Profitability analysis is key to achieving long-term growth. By understanding your financial strengths and weaknesses, you can develop strategies that support sustainable expansion. Regular analysis helps you stay competitive and resilient. In the next scene, we'll summarize the main points and highlight the importance of profitability analysis. Let's recap the main points covered in this video. Profitability analysis involves understanding different types of profit, calculating key ratios, and using financial data to inform decisions. It supports business planning, attracts investors, and encourages sustainable practices. By avoiding common mistakes and embracing continuous improvement, you can maximize your business's potential. In the next scene, we'll provide actionable steps for implementing profitability analysis. Implement profitability analysis. Start by gathering accurate financial data. Calculate gross operating and net profit, then analyze key ratios. Regularly review your cost structure, pricing strategies, and operational efficiency. Benchmark against competitors and use insights to drive improvement. In the next scene, we'll discuss tools and resources for profitability analysis. There are many tools and resources available for profitability analysis, including accounting software, financial dashboards, and industry reports. These tools help automate calculations and provide real-time insights. Choose solutions that fit your business size and needs. In the final scene, we'll conclude with the importance of profitability analysis for business success. Profitability analysis is a powerful tool for any business. It provides the insights needed to make informed decisions, drive growth, and ensure long-term success. By understanding and regularly analyzing profitability, you can build a resilient, competitive business. Thank you for joining us on this journey. Remember, profitability is not just about numbers, it's about creating value and achieving your goals.